Good afternoon, everybody. Thank you for sticking around. The panel was supposed to start a little while ago, but I've been able to keep all 4 of our investors in the room, even though they've got other meetings to go to. So we'll make sure this is a very productive 30 minutes. What I always do say is, as we're going through the conversation, think about any points you hear, any themes you can pull out where you might have a question for someone on the panel or a wider observational point, because I will make some space at the end for questions. So be mindful of that as we go through our conversation today. Conversation is a big one. Venture debt. It's one of the most kind of talked about, but I would say least understood instruments in African tech right now, namely because a lot of the founders I speak with often are asking me, what is debt within the ecosystem? We understand equity, and this is what we're trained to look at as the kind of investment vehicle and capital that we would raise. So what I want to do for today's session is kind of really take it back to fundamentals and basics and kind of look at 2 topics. Kind of what is venture debt fundamentally, particularly with how it works, and then with relation to the African venture ecosystem and how it intersects with other types of investment categories. Should we be thinking about it and should we be using it within the ecosystem? But before I do, it's worth just everybody quickly giving an introduction themselves, but actually probably more pertinent for the audience here is what's your relation to venture debt? Do you have a debt fund, or are you an equity fund manager, but you have portfolio companies go after venture debt? So we can also understand that perspective. So Zach, I'll start with you and we'll work our way across. Quick introduction and, relationship to venture debt in the ecosystem.
Sure, thanks. And then thank you for all the incredible work that you do in the ecosystem to facilitate conversations like this. Zach George, I'm one of 2 managing partners at Launch Africa Ventures. We are the most active early stage VC fund in Africa. We've got a portfolio of 164 startups across 25 different African countries. And we currently manage just over $50 million in AUM. Venture debt is super important for us. We don't do it just yet. We are a specialist seed and pre-series A equity fund, but a lot of our portfolio companies often come to us with working capital needs, for which equity is by far the worst way to fund that. So we actively are looking at venture debt providers or RBF, revenue-based financing providers. So, but a lot of them tend to be region-specific because of the currency issues. So we are probably the most interesting deal flow partner to venture debt and RBF providers because we can provide them region, sector, and product-specific companies that could meet their funding requirements.
David.
Yeah, so I'm...
Let's check the mic on this one. AV, sound.
Hello.
Maybe give me the mic in the meantime.
Yeah, so hi, I'm David Kleiterp. I'm the managing partner of Mobilis Capital Partners. So basically, it's a spin-off of Antep Global, where we were doing revenue-based financing, and we did that through data integration with the companies that we would invest in. It was not only revenue-based financing, but also term loans that we were doing. Right now, I'm raising money to keep continuing investing in the companies that we've invested in. Venture debt for us is our bread and butter in the last 3 years, and happy to explain more about it.
Thanks, David. Lucretia?
Great. Am I mic'd up? Yeah? Cool. Yeah, so I'm Lucretia Chopera. I am Africa Deal Flow Manager for Catapult Ocean. We are a global impact fund headquartered in Oslo. On the African continent, venture debt is important for us in that our portfolio is climate focused, specifically blue economy focused. We back early stage investments across the globe that have a positive impact on marine life and oceans, but our mandate does also extend to land in terms of circular resources. A lot of our portfolio businesses do have a hardware component to them. Although we don't have a port for debt specifically, most of them require that as part of their business models.
Morning, Tamim.
Hi, everyone. Is it working? Yeah. My name is Tamim Azain. I'm sorry, the photo is not contractual. I'm one of the founding partners at Seed Stars Africa Ventures. We are an early stage that was a fund that was built on top of an accelerator that's been active in Africa and emerging markets since 2012. And as part of this Africa fund, we do bring a lot of support to entrepreneurs and help them raise more capital, including debt. And so we've really supported a lot of entrepreneurs understand what terms are acceptable, what kind of debt is acceptable, or they should be or not accepting. And so we do not run a debt vehicle ourselves just yet, but we have facilitated quite a few deals. So very happy to be part of this conversation.
Amazing, thank you guys. So bookmarked by 2 venture funds that are touching upon venture debt with some of the portfolio companies. Somebody's very much worked in that financing space. And then over here, obviously, blended finance in the climate space is crucially important. So it's kind of embedded in the type of industry you build. Okay, so let's go back to fundamentals. Let's cut through misconceptions. Let's ask that simple question. What is venture debt within the African context? Maybe, David, I'll start with you. Could you just give us a baseline of what is debt and how should it be looked at from a baseline for any startup founder in the ecosystem?
Yeah, so venture debt is basically the financing of the underlying cash flows of the companies that basically generate those cash flows, whether it's assets or whether it's revenue. What we want and try to do is estimate how much cash flows you actually receive, and then we would be able to finance that. I think there are, of course, different aspects that come to it, whether, like, what's the life of the asset that we finance, if it's a short working capital loan, or if it's a mobility, like a boda driver that we can finance. So you can look at it from a different perspective, but as well as so what we didn't do was OPEX financing, but you also have debt that would finance the operation expenditure of these companies.
Okay, and so maybe then, Chris, coming on to you then, if we've got that baseline understanding of what venture debt is, when is debt the right instrument for a startup? So obviously we know how to now write that investment, but when is it the right instrument for a startup? And I guess when is it not the right instrument for a startup? And it probably is so pertinent with you because within the climate financing space, blended finance stacks, debt is a critical part of that kind of funding continuum.
Right. So especially on the continent, what we're seeing, I think if you were in the keynote speech that Maxine gave, of the 3 billion that was extended to Africa this year, you find that over 40% of that was actually venture debt. So it is increasing in relevance, especially for climate, specifically because of the hardware component that's required for most of the innovations that we see. If I take an example of one of our portfolio companies, Keep It Cool, he is aggregating fisheries in Kenya, but what he needs to do because of the infrastructural gap that generally we find on the continent is that he not only is aggregating and impacting traceability in fisheries, but he also needs to reduce post-harvest losses. And the one way of doing that is making sure there is a refrigeration component right at source, but also in terms of logistics to give them a pathway to market. But what that requires, instead of just the traditional equity or grant funding, which we're seeing a lot of in blue and climate in general, is that it makes sense sometimes if a founder is now needing finance to buy assets, for it to be venture debt. So that's where we're seeing venture debt come in. But if we look at the continent in general, most of the venture debt that came in for to fund things like mini grids for sun culture, for example. It does make sense then to maybe rethink just pouring equity into those funding structures, but instead use debt instead.
Well, a follow-up question there with those companies, and again, it's probably, I should know, I was going to give an answer for you there. How many of these companies raising debt that you're working with, it's a proactive thinking down the road versus a reactive, we're going to raise debt now? Is it how much of it is, we've got a plan, we're going to raise equity now, debt later, or is it we're raising equity and then debt suddenly comes as an option later on?
I think for a good VC that's putting equity, we have to say needs to be good venture debt. And good venture debt is not just debt for the sake of it. There needs to be a clear pathway to cash flows, right? So you want to put in the venture debt where the company has revenues that will enable it to repay the debt. So you want to make sure that they're not just high growth, but they also are capable of actually repaying the debt. And that requires, recurring revenues in some instances. So if you look at alternative energy space, there is a lot of recurring revenue structures in their business model. Also, if you look at alternative energy, you structure it that way, right? But if you look at fisheries, it might be tricky because some of the fisheries that are coming are actually not in a space where they can pay subscriptions. So you need to actually make sure that there is a structure in place. For Keep It Cool, for example, it's because they are a pathway to market. So at the end of, that, there is the mama sakis that are purchasing fish from them. So there are revenues at the end of that, both in poultry and fisheries, that supports the venture debt aspect. So a good VC would just make sure that they support the founder around making sure that they are ready for venture debt.
Okay.
Yeah.
Good VCs.
Yeah.
C-Stars, Launch Africa. I'm going to kind of throw this to both of you. You mentioned there with Maxime's presentation about 40% of the capital raised was venture debt, okay?
Yeah.
You guys have got quite big portfolios of companies in your funds. How many, just a snapshot if you can share, how many are actively or have raised venture debt in your portfolios, do you know? Even if it's just a lick of the finger kind of guesstimate. Do you want to get a sense of kind of what you're seeing on that side?
Yeah, well, in terms of the number of companies that should be out there raising venture versus numbers that actually have, is quite a big differential. So I think I would say ballpark, somewhere between 70 to 80% of our companies should be raising venture debt. It's quite a bold statement for me because we've got a lot of portfolio companies, but the amount of founders that struggle with basic cash management from a working capital perspective is incredible. Just not being able to manage their accounts receivable versus payables and inventory is shocking. And because there aren't traditional lenders, so sort of like bank financing in not just South Africa, but Africa as a whole, they are forced to go and raise money from equity, ventures. So I would say easily 70 to 80% of our founders should be raising venture debt. The reality is less than 10% of our portfolio companies have raised venture debt. So there's a big gap. Mm-hmm. Now, the question is there a supply-demand arbitrage here? Yes. I could not on my fingers count the number of formal venture debt firms that do Pan-Africa venture debt. Like I mentioned earlier, a big part of it is currency, right? The ideal financing situation from a venture debt perspective would be local currency, high single-digit interest rate. Now, that's a pipe dream, never going to happen, but it is something we can all aim for. But if we can do local currency venture debt, low double digits, low teen double digits, still okay. The reality is most venture debt is hard currency, so dollars, pounds, or euros, and typically 12 to 15%, which if you factor into just the last 3 years of currency depreciation in the biggest markets in Africa, Egypt, Kenya, and Nigeria, which also happen to be the most depreciative currencies in the continent, it almost becomes impossible for founders to sustain that level of debt repayments, even if it's just for working capital. So there needs to be either the big banks should be playing more in the hedging space, or you've got to have low-cost funding to low-cost cost of capital to venture debt firms that can then give slightly more reasonable terms to founders. Otherwise, this becomes a self-defeating spiral that will never end. But the gap is massive from a requirement for venture debt perspective.
What about over at C-Stars? What are you seeing?
I think I agree with the target, and I think reaching it depends on where you are on the maturity stage. So typically within the Africa fund we have, which invests in Series A and pre-Series A or late seed, I'd say that 80% of those companies actually have raised some form of venture debt. But again, because they're pretty advanced in terms of the equity raise they make, the revenue they have, etc. On the acceleration side, where across funds we have 140-ish companies, 25% of which are in Africa. I agree with the target, and I agree also that what startups are able to do is much lower than that, probably in the 20%. And I think there's one problem that doesn't help raising venture debt. It's the stacking of safes, which is a major issue because most lenders will not consider that properly equity against which they are happy to lend it. And we are in an ecosystem that has been relying, I think, that in my opinion, a bit too much on those safes, and hence the lack of debt funds that are able to invest in Africa.
I was literally going to come to you and say, well, then how do we solve for that, or what is your take on that, particularly the safe stacking?
No, here, I mean, I think in general, right, like, of course, we would like to have low double-digit local currency returns, but the reality is that our funders are not giving that to us, right? So if my funder is saying, okay, here's a note for 12% US dollar, then immediately I need to price it as well. Mm-hmm. And I think that, of course, there's also a little bit of a different play that it would help you as a venture capital investor. But there's also the realities on the ground that there's a risk aspect to it, right? So for a venture debt fund, one blowout is massive, right? So you won't basically you probably will then get some of your money back, but not all of it, and that becomes also a problem. So there are multiple layers to that, which is not, it's complicated, but I do think that when you're working together with the VCs, right, and you are basically structuring the right instrument, the right tenors, then it can be really helpful. So from a safe perspective, it depends on the investor how they perceive that. Basically, we never had that much of an issue with it. I think we always took a risk, and that risk then we also priced accordingly, which was unfortunately higher double-digit returns.
Okay, well, sticking with you then for a second, we kind of flip the switch a little bit here from kind of what it is, going a bit more of the detail, though I don't want to get too technical, but again, when we're talking about debt here and what we've heard in the conversation here, we're kind of hearing a very kind of the high-level view of it, but there are multiple structures to how you can raise debt capital, right? So for the founders in the room here who are kind of new to that, the ones that have just pitched here who may be looking at venture debt capital now or down the road, what are the 2, 3, or 4 kind of headline types of funding, kind of structuring that work best here on the continent? Yeah.
I mean, for us, mobility enhanced asset financing, and therefore, whether you want to call it revenue-based financing or collection-based financing, has worked very well. Because it's also easy to track and basically you're able to match the tenors of the contracts with what we want. And it's basically because of the principal payment that you then get back quickly, we're able to get good returns of that. A term loan is a little bit more difficult because also from a currency perspective. So I'm always in favor of basically short tenors. And then also trying to reinvest those short tenors. The other one is it's like a revolver, right? So where you can give a credit line and then basically you can ask for it back. But that's also dangerous for a venture debt fund because once you want to get it back and they don't have the money, then you have an issue. Yeah. So those are the 3 different options.
Chris, you want to add something to that?
Yeah, what I've seen in climate that's really interesting is that because climate is a different problem because of the things that Zach raised, like around, the interest rates being too high. What's ending up happening in climate is that for early stage support, you get a lot of foundations now throwing grants over and over again at early stage investments. And we don't support these grants going to like asset financing, for example. And the one interesting conversation that's happening now in terms of aligning capital stacks is just, you know, to make sure that maybe the foundation underwrites some of the, you know, debt instruments that are being deployed by banks. But what's interesting is that it's not pushing down the rates. So the honest conversation that needs to happen with debt funders is when it's, you know, there's security on the instrument from foundations or DFIs, there needs to be, you know, it needs to reflect in the interest rate that's now being offered to funders. But we've seen a lot of collaborations now with DFIs coming through for climate with local banks even, just to make sure that there is that protection around currency volatility and also interest rates, high interest rates, which is cool.
Okay, well then let's take a step back from the kind of the models constructs here. Again, we've got a heavily VC panel here, and a lot of the conversations today and the founders pitching now, we're talking about venture capital and VC investing. So let's take the scenario that, you know, you've got portfolio companies that have raised equity financing from yourselves. They're now looking at venture debt as their next capital allocation. What role does the VC community, you as fund managers that have already invested in portfolio companies, have in enabling that debt? Are there reporting or governance obligations, underwriting processes? What role do you have at all? Do you have to pass on the baton in a very hand-carrying way, or is it completely separate to you? What is that relationship you have with the debt providers as the traditional equity VCs? I guess it's an open question to probably start with Zach or Tamim.
Before going there, I just wanted to step back and add something to what Chris has said on the modeling and linking that also to what you guys were mentioning on the rates. I'm not going to disagree. The lower the rates, the better for everybody. If we can get single digits, I'm all for it. But I think again, I don't think we're going to get there. So what's important is really for the entrepreneurs to model what kind of acceleration will the debt allow them to reach. And only then you can decide whether 12 or 15% is acceptable or not. And I think there's a number of parameters to look at to make that decision. One is if you have, or actually, let me give you two examples. I think the first one is if you have low CAC LTV ratio, it means that you will not very likely be acquiring customers fast enough to be able to generate recurring, predictable cash flows to pay that debt back, right? And so if the interest rate obviously is too high, then you can't service the debt. The second example I wanted to give, sorry, it just slipped my mind, but I'll get back to this in a second. And so the role that we play, sorry, in this equation is first, when the entrepreneurs raise equity, we immediately advise them to start looking for debt. If they wait 6 months, 1 year, they will have burned significant amounts of the cash they raised, and so the debt conversation becomes a lot more difficult. So immediately after, and then so we obviously help them connect with the right lenders, or what we think are the right lenders, and we help them negotiate. So the thing I mentioned before on that modeling, on the CAC LTV thing, on the terms that they can get, whether they get a grace period, whether it's there are warrants attached to the debt, all these things. Entrepreneurs very often need help navigating these things because it's not obvious, and I think there's not a very strong level of knowledge yet in our markets of how these instruments work, and so basically we help them navigate that. Especially, I think there's one aspect that we are very focused on. It's the guarantees that some of the lenders take on the cash, the control that some lenders ask on the bank accounts of the startups, and we need to be very careful about that because obviously if there is a security on 50% of the cash in the bank account, that equity is not wisely used. So that's what we help with.
So we don't have much time here, but I want to just add a very important point, is that venture debt is not the same as traditional debt. This seems obvious, but it's not obvious to a lot of founders. The big reason why most good VCs will run to the hills when a startup that they're looking to back has a lot of traditional debt on the cap table is because we have almost a decade of precedence in markets, specifically East Africa, with the climate tech industry, where the heydays of, Copa, M-Copa, Copia Global, PowerMe, like there is a long graveyard of climate tech startups 10 years ago that stacked their capital with debt financing for solar panels and pay-as-you-go solutions, and the equity holders got wiped out because of way too much leverage, right? So, but a lot of these founders aren't investment bankers or private equity folks that understand what debt covenants are, that what coverage ratios are, and it is shocking how VCs could even go and fund these companies with such huge amounts of debt. So, venture debt should, in an ideal sort of world, be only used for financing shortfalls in working capital and maybe a tiny bit of asset financing. Venture debt is not a substitute for asset financing, because VCs are not in the business of funding businesses where they're at the bottom of the cap table and will never see their money in years, if not decades. So you've got to be very careful. Equity capital founders that are looking to raise money for tech, product, and marketing, very happy to talk to VCs. If you're looking for asset financing, especially for a climate tech startup, you should not likely be talking to venture debt providers. You should be talking to funds like Untapped or, traditional asset financing firms. Venture debt is that little go-to in between where you're collateralizing your assets with software solutions and to plug that hole in your working capital shortfall. That's where venture debt comes in. If you start abusing venture debt to finance your CapEx, you're going down a very slippery slope. And us VCs ain't happy about that.
And on that bombshell, we're going to go to Q&A with the audience. I feel it kind of wraps up nicely.
You got to call a cat a cat.
We're going to see what the audience has got to say about it. So I can't actually even see the screen from here, but I think we've probably got 3 minutes, 2 minutes. Okay, close enough. We'd like to take any questions from the audience.
I knew Raj would have questions.
Oh, and Roger's here. Yeah, there we go. First one here on the...
Move that white sofa.
This is a question that Zach, you and I have talked many times, and you've raised this now, but nobody seems to have come
Quickly
up.
introduce yourself, just so we've got the context for it.
My name is Raj Kulasingham. I work for Denton's, the international law firm, but I'm also an investor in a bunch of startups. I've invested with some of the people on this table. So the subject is the stacking of safes, which we all understand is a particular issue, but no one seems to come up with. Everyone says it's a problem, but no one's come up with what's the panacea, what's the Panadol, what's the solution. So I'd love to hear from you guys, because we've all been at the back end, the sharp end, or whatever it is, of too many safe notes, right? As an early investor, when you go in and say, okay, we all understand the safe has pros and cons, but mostly we say, okay, it is easy, blah, 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 so we'll just do a safe. But what then? What protection can you build in for these problems that come on? I've seen 5 lots of safes stacked one on top of another, and nobody understands where any of this unfolds. So and if we do have a solution, how can we make that either general practice or best practice or advice to the ecosystem as a whole, so that it's both sides of the fence?
I'm happy to give it a try. No, I think so. Again, I'm not advising against safes, and I think at the very early stage, it's perfectly fine, right? But at some point, we need to have a price round that will convert all these safes into something more predictable. The reason there is so many safes in Africa is because there is an obvious lack of capital, and that average fund size is small. The final size of a VC fund in Africa, on average, is 40 million. That's the average. So the median is probably closer to 20, 25 when you remove the Partex and the TLCom. And so when you have funds that have 20 million to invest, they can only write small checks. They cannot really lead rounds. So the incentive to write small checks as safes, even as at the institutional fund level, is pretty high. So we need more funds that have the capacity to write these larger checks. And larger checks doesn't mean like 5 million, 10 million, right? It can be 500K, it can be 1 million. And once we have that, we have less incentive to have this stacking of safes, basically.
I mean, I'll just add one point to that, and it's a technical thing, but post-money safes, founders get screwed. Pre-money safes, VCs get screwed. Right? Simple math. I mean, the math I'll explain later if you want to meet me backwards. But the reality is there has to be maybe, in addition to MFN clauses, there should be something in safe notes, Raj, that limits the number of future safes you can issue prior to conversion. I mean, MFN clauses came as version 2 after the post-money safe. There should be a version 3 that limits the safes, like convertible notes, should have a maturity, but should not sit on your cap table as debt. That would be, I think, the ideal solution, is have a maturity to safes, but not have it as debt. Yeah, something like that, yeah.
Or amounts.
Or have a forced, yeah, you're right, an amount, a dollar amount, and a forced conversion, yeah.
Okay, we're going to go to our final question now because I'm going to get played off in a second.
Yeah, hello, my name is Ferris, and I work for an investment readiness program, so this is a recurrent topic with our startups. And I want to know something, since you've mentioned that everybody knows that debt is super expensive, double digits. So it's also a matter of managing that debt, and that's a test for the startup to know to see whether they have the right processes, so they can like optimize the cash conversion cycle. Do you think in your portfolio that the founders are equipped? Do they have the capabilities to understand managing cash flow? Or is it going to be an additional burden for them by taking more time on their bandwidth or hiring somebody to deal with that?
Yeah, I mean, from my perspective, so we were investing in different stages, right? So I think especially from a very early stage, finance is probably not the department that people invest a lot of money in. And hence we were always looking at the ability and the willingness to pay, and I think there's a willingness to pay, but if their cash flows are tight, then even with a revenue-based financing approach, right, you would still see that, well, the management would say, you know what, we'll just keep it all, and then we're because we need it for operations, right? So to try to get to an answer, so it depends really on the startup. And I think personally that there needs to be TA facilities there, right, from the DFIs and other impact funds to help these companies with understanding and managing those cash flows.
Yeah.
Sorry, go ahead.
Yeah, we have.
I'm going to give Lucretia the final word because Kino is going to come here and kick us straight off stage in a second.
Would never do that.
Yeah, our portfolio runs the same. Our business model is we offer technical assistance, and you get access to between 150 to €500,000 for that reason, so that we make sure that the founder, because most of our founders have a marine background or a science background, so we need to make sure they understand their cash flows. So by the time they go through our accelerator, they are very close to their business model and understand it. So, yeah.
And I think at some point, again, going back to the maturity stage of the companies, they don't understand cash flows. There's probably a bigger issue that we need to solve.
You have 10 seconds.
Something very controversial that I might be crucified for.
Now, hold on. Did you say 10 seconds to Zach?
Yeah,
you said 10 minutes.
And a controversial cutoff point.
Yeah. So do you know the good old-fashioned debit orders for your insurance policies and mobile phones, etc.? Now imagine when founders take on debt and I have payments to make. Imagine if someone structured an instrument and saying that if you miss your payments 3 times, your salary gets deducted by the amount you lost your payment by. Then I'll bet my bottom dollar founders will suddenly become very financially literate and start paying or start taking on less debt, matching their affordability. But it's considered so, what's the word? Hurtful or uncool to ever deduct something off of someone's salary. But the insurance companies and banks do it. for us as individuals. So imagine applying that concept to startups. I'm just dropping a little seed and planting a seed here. Financial literacy starts when it affects your back pocket.
Okay.
You can drop the mic now.
Okay.
Yeah.
I mean, but that's why they make comments about, you know, what do you call a banker at the bottom of the ocean? Or, so.
Anyway, on that bombshell, Zach's investment readiness and debt workshop will be outside for founders after this. But I'd like to say, Tammy and Lucretia, David, Zach, thank you for joining this afternoon, and thank you all for listening, and enjoy the rest of Africa Arena and Africa Investor Week. Thank you.
Thank you very much.